Welcome back to the channel where finance meets common sense. If you're here to get rich overnight, well, let me introduce you to the nearest casino. But if you want to understand how Wall Street has, time and again, played the market like a Vegas magician, you've come to the right place. Today we're diving into the fascinating yet frustrating world of market manipulation, specifically how the street influences retail investors like you and me through the media, social platforms, and even government narratives. And most importantly, how you can avoid being their favorite chess piece on this financial board. All right, first things first. What do we mean by market manipulation? The SEC defines it as the intentional interference with the free and fair operation of the market, often to deceive investors. But let's be real, do you think Wall Street's billion-dollar hedge funds are worried about a few SEC rules? That's like a Formula One driver worrying about a speed limit sign. Now, most manipulation doesn't happen in broad daylight. Instead, it's often disguised as expert analysis or breaking news. Ever heard the phrase, buy the rumor, sell the news? Yeah, well, what if I told you Wall Street is usually the one planting the rumor in the first place? Let's break down some infamous market manipulation moments where Wall Street used media and public narratives to their advantage. The first one is dot-com bubble, late 1990s to early 2000s. The late 90s, when everyone thought adding .com to a company name would guarantee riches. Investment banks and analysts hyped up companies with no revenue, yes, $0. Research by universities and institutions points out that many major financial institutions rated these companies as a strong buys, while simultaneously dumping their own shares. Moral of the story? If the analysts on TV say it's a sure thing, Wall Street has probably already cashed out. The second one is the 2008 financial crisis and the housing bubble. This one? Pure cinema. I mean, Hollywood literally made The Big Short about it. Banks pushed subprime mortgages, bundled them up in fancy securities, and got credit rating agencies, who, let's be honest, were basically their co-conspirators, to slap AAA ratings on them. And guess what? They knew it was a house of cards. Lehman Brothers and Bear Stearns collapsed, but who got the bailout? The big banks. Meanwhile, retail investors and homeowners got a front row seat to financial ruin. NPR reported in 2010 that major media outlets downplayed the risks until it was too late. And the third one is GameStop Short Squeeze 2021. Fast forward to the meme stock era. When retail investors turned the tables and squeezed hedge funds betting against GameStop, Wall Street's response was, let's just say, less than sportsmanlike. Remember how Robinhood and other platforms suddenly restricted buying shares? Well, Reuters reported that several major institutions had direct ties to the firms managing those short positions. Publicly, Wall Street claimed it was about protecting retail investors from volatility. Yeah, sure. Because they're all about looking out for the little guy. Now that we've seen some of their greatest hits, let's break down the playbook they use to control market sentiment. The first one is called the hype and dump. Wall Street firms and respected analysts pump up a stock. Media jumps on the bandwagon. Retail investors FOMO in, and boom, right when the stock peaks, the big players exit quietly. Case in point, CNN Money reported that investment banks have been caught promoting stocks they were secretly selling. The second one is called the fear factory. Ever noticed how every time the market gets overheated, suddenly CNBC starts running impending recession headlines? The Economist once published a study showing that fear-based media coverage spikes before major corrections. Think about it. Big funds need you to panic sell so they can buy at a discount. And the third one is called the bad news timing. If a company has to report bad news, say, and earnings PR teams often leak a different bad news story to distract investors. Bloomberg once noted that companies strategically release bad news after market hours on Fridays, hoping you'll forget by Monday. So, what can you do to avoid being Wall Street's puppet? Here are a few golden rules to keep you sane in the stock market jungle. Rule number 1, ignore the noise. Media thrives on sensationalism. There are a few unbiased sources, so always cross-check before making decisions. If Jim Cramer tells you to buy, it might be time to reconsider. Rule number 2, follow the smart money, not the loud money. Instead of listening to Twitter gurus, track institutional investor moves and scroll the financial reports if you have 5 minutes of coffee time every day. If Warren Buffett is buying, it's probably a safer bet than your neighbor's hot tip. Rule number 3, have an exit strategy. Don't just think about when to buy, have a plan for when to sell. Set stop losses and don't get greedy. Remember, the market doesn't move in straight lines. Rule number 4, think long-term. Daily stock moves are often manipulated, but in the long run, fundamentals usually win. As The Economist states, stock market noise is temporary, but economic value is permanent. All right, that's a wrap. We've seen how Wall Street plays the game, how the media is often complicit, and most importantly, how you can avoid the traps. If you found this helpful, hit that like button, subscribe. Remember, investing always carries risks, and while we can't predict the future, we sure can be more informed players. See you in the next video.